Hey guys, welcome to episode 2 of Straight into Options.
Hey, welcome everyone.
I'm your host, Swing Pony.
And this is Drippy Too Hard.
Drippy, drippy, drippy. What a week we had last week.
Disaster.
Disaster. What's the word for that? Is it poopa?
It's the poopa, is the grand poopa.
It's the grand poopa. So I definitely want to talk to you a little bit about that. Guys, this episode will be a continuation of last week's episode. We had Options for Dummies Part 1. This episode will be all about Options for Dummies Part 2. But before we dive into all of that, we cannot continue without discussing the absolute carnage that took place last week, specifically on Thursday and Friday. Drippy, how did that go for you? What are your thoughts?
Yeah, I was, Thursday was kind of unexpected, because we did have a decent week before and we were doing fine until Wednesday. But Thursday was a massacre. Like, no supply demand zone, nothing worked because it was just this like a waterfall.
Yeah, I mean, we
And
knifed through every single level, like
yeah,
butter. It just glided down like butter.
yeah, so I kept missing my bids. I didn't want to chase, but it kept going down, and it was unexpected move for me.
You know
But
what's so funny? I posted a tweet which I think was highly relatable on
mhm.
Thursday, and I was like, if you sold your puts too early, I feel you, I hear you, I am you. Because I literally that morning, like I played puts on Rivian, I played puts on PayPal, and I freaking killed it. And I was so proud of myself and I locked profits. And then, pardon my French, that shit just kept falling.
Mhm.
And, both Thursday and Friday, it kind of, I have this mindset that kicks in that I need to be more aware of. I keep thinking like, okay, but it's got to bounce at some point.
Yeah,
So even Thursday, I could have re-entered puts, but to me it just seemed like there wasn't that much risk reward left to play the downside because I was anticipating some form of bounce, and really that just never came.
yeah, same. I mean, I kept missing my entries because I don't like to chase during the open, and I was waiting, after 30 minutes into open to get into with a decent risk reward, right? At least retest of EMAs or something, but
Yeah.
it was waterfall, and I mean, it's one of those days you can't really predict. So you did really well actually by taking profits because
Of course.
you never know. This is one of those days which happened to be, where you held runners and it worked. But what about the 99 other days when it doesn't, right?
1000%. I always say, like, I'm just here for my slice of the pie. I'm
Yeah.
never expecting to take on the full move. My previous mentor, Radio Silent Play, he actually used to always compare, a trade to like a cheeseburger. And he would say, like, I'm just here for the meat of the move. Like, I don't need to get the patty, the cheese, the lettuce, the onions, and the meat. Like, I just need to take a portion of that, because if you try to get the full move, it's never going to happen. It's not realistic. So, you know,
100%. Yeah. I mean, like, I like this tweet by Adam Sliver the other day. He's like, coulda, woulda, shoulda account is a 9 million, is a nine figure account, which is true, right? You
yeah.
could have made that, but you were not in the trade and you took profit early. So it's fine. I think Friday was another opportunity and I took advantage of it on Friday. So after seeing Thursday's price action, I was like, oh, this looks bad. There's something bad. And for initial thought was that's because of the, uh, you
The
know, uh,
hawkish Fed.
yeah, like Jerome Powell said that we might have 75 BPS hikes and stuff like that. But that has been in the news around, right? But then on Friday after the close, we hear this news, right? That Wells Fargo is firing their mortgage department employees, roughly, I think more than 500 plus employees. And the reason is that mortgage
Wow.
loan growth has slowed down, and it was 33% less this earnings, but as per like Reuters, and the rates for mortgages are up from 1.5% since the start of the year, and they're highest since 2020, I believe. So because of this now, there's been talks about, how housing market is looking weak, and we have reached the peak, and now it's declined from here. So stock prices are kind of reflecting that, but the price action kind of is hinting towards something more ominous coming.
Yeah, it feels sort of like a perfect storm, and I'm sure the fear's going up, which also it kind of makes me wonder, going into next week and Monday, do you think we're going to see some form of relief rally or, continuation? I know we're in no position to predict the market, but what could next week look like?
So I'm expecting that. I mean, so if you look at this data, like put to call ratio, PCCE of the whole broader wide market, right? You can see it's greater than one. And that has happened only last couple, like at least in the last couple of years, once or twice, during the COVID crash.
Wow.
And usually, we have a rally after, put to call ratio is so high, and market makers need to kind of burn those put premiums, right?
Mm-hmm.
So, and the call premium, the IV is super, like low, because not a lot of people are buying calls in the market. So since the skew is kind of unbalanced, I mean, it's like ratio is not balanced, and things tend to, like, especially with IV and like premiums, things tend to, like, mean revert fast, especially when they're stressed so like rubber band stressed so thin now.
Mm-hmm.
So what I think is that, we might see a residual sell off on Monday, and then we have you know these large cap earnings coming soon, so we could
Yes.
see some relief based on them, and now everything is kind of hinged upon them, their earnings. But in the longer term, I don't think these earnings matter a lot. There's some bigger things happening around us, which earnings don't really play a lot of role into them, because last earnings were pretty good for Google, and the stock is not showing that, it's not reflecting that.
Okay, so you know which earnings I'm most curious about. I know we have Apple next week, so that one should be very interesting. I'm
Hmm.
curious about Apple. And then when's Amazon? Do you
I
know?
think Amazon is next week as well. It's
Okay.
I think it's on 28th.
So I am dying to see how Amazon plays out. And the reason is, if you remember in their Q4 2021 earnings, almost 12 billion of their revenue came from Rivian,
Right.
their investment in Rivian. And I don't
Hmm.
know if you've looked at Rivian lately, but the stock it was trading at almost like 170 or 180 in November. And now it's in God, the low 40s or the low 30s. I'm not even sure. But I'm very curious to see, if Amazon takes a hit on earnings and they can no longer rely on Rivian as the crutch that they were able to in Q4, you know, I think there's a lot of pressure on, how Amazon could turn out, because we did get a huge bounce after Amazon earnings, if you remember.
Yeah, I'm bearish on Amazon earnings personally, because, as apart from the reasons you gave, we saw that Netflix said that the subscription growth declined for them, right?
Mm-hmm.
And my guess is that we'll see something similar for Amazon as well, because they already declared they're going to increase the prices for the Prime subscription.
Right.
And on top of that, we have, like logistics and supply chain issues. So prices for transporting the goods were high last quarter. um, so combining these factors, and as other things, looking at the macro environment, like the earnings need to be blockbuster, then only the stock would be saved after earnings report, I think. Otherwise, even if there's sign of like, anything weak, the market is so weak that
Mm-hmm.
that will, like, just lead the stock to, plunge. And the flow is super bullish though. So, it's a mixed bag. The flow is very, very bullish for Amazon, like, especially near term out of money calls. They're just buying 3,100 calls. Stock is at 28.80.
Wow,
So
yeah. I mean, look, you never know. You never know.
yeah, it's just a speculation, I think. Right now, I think they might also expect it to rally before the earnings, and that could be a trade they're thinking about. Um,
To
but
build the premium
right,
based off the IV.
but I don't know. Maybe I'll just sit on the sidelines. I don't need to trade earnings. I mean, the max you can make from earnings is what, like 1,500, 1,000%, on Amazon, because the IV is kind of high, and I don't think Amazon is going to drop like a rock like Netflix.
Look, I gotta tell you, with Netflix, the funny thing about it is it was just last week that I was sitting in my room, I turned on the TV, I'm bumming off of my best friend's Netflix account. And as I click to watch something, I get this notification that comes up and says, you cannot watch, there's already two other people like watching from this account. And that was the first time that that had happened to me. And I
Mm-hmm.
was like, what?
Yeah.
Like, how rude. It's so funny though, because I have like 6 streaming services. I pay for 2, we share 4 other ones. But it was very interesting that that just happened. And then we went into Netflix and realizing that that is a huge issue for them.
Right. And also, Walmart is a big competition for Amazon Prime now, because Walmart Plus is pretty solid. And in case I mean, everyone has noticed, for folks who have not, Walmart is all time high.
Mm-hmm.
Amazon is not. And so money is flowing to Walmart. And where is that money coming from? You know, very similar
Interesting.
business, very similar business, Amazon and Walmart. So they're competitors, and Walmart has a lot of people, I mean, a lot of shareholders are interested in it. That's why it's holding steady in this market. Walmart didn't really drop a lot. Actually, it was down maybe like 2 or 3% this whole week, or even break even. So looking at these things, I think, Walmart, Amazon, I'm bearish on Amazon earnings.
Yeah, I tend to agree with you, and that's largely because of my Rivian concern and bias, and
Mm-hmm.
it sort of feels like it could be the straw that breaks the camel's back in terms of the market. Because like you said, any tiny little miss feels like it could create a very, very exaggerated move, like we saw last time with like Facebook, who has hardly recovered. Like it was just starting to, and then it gave it all up. So a lot of
Right.
interesting times going ahead. I know earnings after hours are like my Super Bowl Sunday. I just sit there with popcorn and I watch that first 5-minute candle go up and down and up and down. And I have a lot of fun with that. But
I've almost stopped playing earnings or autos anymore. It's just so like unpredictable, right? I mean,
yeah.
I have a better SPX UDT strategy,
Oh,
like, which just like the on Friday last 15 minutes trade was almost 2,000%.
okay.
I
I think we're gonna have to do an episode on your
yeah.
SPX lottos because that's crazy.
Yeah, but I think like, we should talk about the topic for the day. A lot of listeners, they probably tuned in to listen to the Greeks, and we're not talking about them.
Yes, so you're fluent in Greek. You're going to teach us some Greek. Before we get to that, though, I do want to do a quick recap of what we discussed on Options for Dummies Part 1. We went with the basics. Calls, bullish, you anticipate the price to go up. Puts, bearish, you anticipate the price to go down. And again, one of my corny ways to remember this is you pick up the phone to take a call and you put it down to hang up. So that's one little way to remember it. In terms of the benefits of options, options can be used to hedge a position. And, one of my favorite benefits of options is the leverage that you get, because remember, each options contract represents 100 shares. So you can pay a small premium and you can have big market exposure on names like Microsoft or Tesla, names that you might not be able to buy shares of. So that's a really big benefit of options, in addition to the fact that you can play a stock up or down. So that's insanely useful in this market that we're in, especially right now, where we are getting so much downside and volatility. That way you can benefit on both sides, You can make up for the fact that your 401k is going down while you're playing puts and sort of balance that whole prospect out. Um, In addition to that, we discussed a strike price, which is the price that you think the stock will go to. And then we also explained the expiration, which is when you're buying a contract, you choose a strike price and an expiration. So strike price, the price you anticipate the stock will be. The expiration is how much time you're giving it to play out to get to that specific price. And then we have in the money options. In the money means the underlying has already hit the price of the strike. Out of the money, it means the underlying is further away. So if I buy, a stock that's trading at $45 and I purchase a strike price of $50, that's out of the money. Okay. So moving on from there, we are going to get into the next round of options basics, the Greeks, which, Drippy, I don't know about you, but these used to terrify me, and they are what kept me away from options. But we're here to make them a little more approachable and a little less scary with a whole lot of analogies, right?
Yeah, that's the goal.
That's the goal.
We should start with the first one, which is drum rolls,
Da-na-na-na-na.
Delta. It's Delta, and no, it's not the airlines. It's Delta, and what Delta tells us is that So before I start with Delta, what Greeks are basically, they determine the price of the option premium. Every option premium, you have to pay a price for it, right? So what determines the price and what determines the movement of the price, up or down? It's not just stock moving up and down. There are other things which play into the role. And that's why option premiums are so attractive to retail traders. The first one is Delta. Now, the textbook definition is that delta is the amount an option price is expected to move based on a $1 change in the underlying stock. So for calls, it's positive value, and for puts, it's negative. So if you're basically, let's say you're buying a long call option and delta is 0.3 and the stock increases, by $1, the option premium should, roughly see an increase in the price of at least 30 cents. And this is how you estimate the price, how much the premium might move. And just to kind of keep things simple, one thing to note is delta is highest around at the money and in the money, and it's close to 1. So essentially it's like you have the shares with you, and as you go out of money, the delta decreases, and it's close to 0, very far out of money. And very simple way to think about it this way, right? Let's imagine a scenario where you're going to a concert, and there's situation for parking. You're looking for parking. Everyone is looking for parking, and the closer the parking lot is to the venue of the concert, the higher the probability you have of getting to the concert on time, and hence you have to pay more price for it. It's more expensive. The parking pass is more expensive, and these parking lots that are further away, they are cheaper, so lower delta, and probability of you making it to the concert on time is lower as the distance increases. So you can think about this distance between the parking lot and the concert venue, similar to how out of money your calls are to the strike price, calls or puts. So that's delta for you guys. Why don't we talk about theta?
Okay, so theta, get very, very familiar with theta. First of all, I want to say the two Greeks when I started out that I focused on the most were delta and theta. So, before getting overwhelmed with trying to understand all at once, I think these are two very, very important ones to focus on. So theta measures the decay in price as expiration gets closer. And this isn't a linear progression. So a contract that expires next week is going to lose significantly more value each day due to the theta, the time decay, in comparison to a contract that expires 2 months from now. So when we talk about buying time, this is why it's important. It's because of the theta. If you anticipate a move to take place and you're purchasing weeklies. Weeklies means, it's going to expire this Friday. If the stock, has a huge volatile move like we saw last week and you were in calls, your theta, as you get closer and it's getting further away from that move, the decay has eaten away at your premium. Now, if you had purchased, maybe calls for 2 months from now, having these volatile moves this close to expiration as a weekly is going to destroy you. But if you were further out, the decay isn't going to be as extreme. You're buying more time to allow the play to take place, the move that you're anticipating to happen. So when in doubt, it's always worth it, especially as a beginner, to buy more time, because weeklies can absolutely destroy you. You can get to Friday and then the move finally happens in the last hour, but because you've already given up so much of your premium because you are so close to expiration, you may not really benefit off of the move. That's something that happens often. Did you experience that a lot, Drippy?
Oh yeah, I mean, my early days were just
Weeklies
like
galore, setting money on fire.
it's basically that, it's basically a lotto, right? Because you're guessing where the price will go, which is the hardest thing within a week. That's why all the big money, they don't buy weeklies. Have you seen 100 million option expiring tomorrow? No, because they are super risky, and that's why they are cheap.
Mm-hmm.
And the lower the theta, the lower the probability of option price to be in the money, and that's why um, you buy time, to lower the risk. And
And
I know, sorry, go ahead.
no, I was going to say, so you had the parking lot analogy for delta. How can we apply that to theta?
Oh yeah, excellent question. So continuing on that, right? Um, let's say that you are a seller of parking pass, you're owner of the parking lot, and you are a little bit further away from the concert. And as the days are approaching, on the day of the concert, you see that not a lot of people are coming to your parking lot. Could be because of the distance or other reasons. And so what you do is you lower the ticket price, you lower the parking pass price. And this is what it is, as the time to the concert is approaching, you're lowering the price of that parking pass, because the probability of people using that is lower.
Yeah, I like that. I like that.
Hmm.
Another non-parking lot analogy that I actually really like to refer to with
Hmm.
theta is to sort of think of that piece of produce that you always buy from the grocery store. It could be avocados. For me, it's jalapenos from Trader Joe's. I swear, I buy them, and if I don't use them within 2 or 3 days, they are no good. They
Expire worthless.
expire worthless, just like those weeklies. So, theta is a very, very, very important one to remember. And like we mentioned, it's why we mentioned buying time. All
Yeah.
right, gamma. Let's get to the gamma.
Right. So gamma measures the rate of change of delta over time. So we talked about the delta, right? And gamma is nothing but rate of change of that. So what does that mean? That means that, how stable is the price of the premium, given the same delta. So for example, in the previous parking lot situation, let's say that, before I go and tell the analogy, like I want to talk about, like, one important thing. Gamma is, higher, and like it's highest in the money and at the money, but as you go deep out of money and you go deep in the money, the gamma is basically zero. um, so this has a big impact, which I'll talk about in a minute. But going back to the parking lot situation now, so prices are highest near the concert and they are lower away from it. But what determines this price is essentially gamma, right? Like what is this factor, you know, like for example, if you go 2 miles away, and other things, like for example, you have two parking lots which are a mile away from the concert, or let's say they are 10 meters away from the concert. So delta is the same, but gamma can be different, because let's say one of them is going through a construction, so gamma is high for that, and other one is not. So what does that mean? The risk is high that the prices of those parking lot tickets can either go high or can go low if the construction is delayed. For example, the prices can just go to half because of the construction. So that's why. Or if they construct something, like they have more additional spaces for last minute additions, the prices can go high. So gamma determines the risk factor in the price itself of the delta.
Okay.
And also, if you're book earlier, you get a parking ticket, a pass, cheaper. But if you book last minute, and near to the concert, the prices of the tickets increase dramatically. So what does that mean? That means that gamma is much lower out of money strikes. But if the strike, for example, is, let's say you got the SPX puts or SPY puts, for example, on Friday, and let's say you were way out of money, you just buying a lotto, and the gamma is super low for that, but the stock actually went there. Since gamma was low and the stock underlying price actually reached that strike, the gamma increases exponentially, increasing the delta exponentially, because gamma determines the rate of change of delta, and hence the premium increase exponentially. And that's why some people, they were able to make 2,000, 5,000. I mean, I heard that some SPX lottos went from 100,000%, and this is the reason why. It was an unexpected move at the last minute.
I like that. So that's also something really important to consider with options beginner luck as well, because a lot of people will buy some far out of the money calls or puts, and then, there is a huge unexpected move and it happens to work out for them and they get that massive percentage move. But it's not always like a best practice or a regular thing that's going to occur. But when it does happen, it can be highly, highly, highly profitable.
Mm-hmm. And then the last one, which people think is not important, but is important, is vega. But before we talk about the vega, we need to talk about IV. So what's IV, Swing Pony? Explain to me like I'm 5.
Okay, so IV is the market's forecast of a likely movement in a security's price. So it helps quantify market sentiment. The higher the IV, the more expensive the premium.
Oh, I see. So in the parking lot situation, that does that mean that there in this parking lot, like a city that charges $10 to park on a normal weekday, on the weekends they're charging $20 or sometimes $50 if it's right near the venue, and then this is due to the priced in demand because of this contextual information. Is that correct?
Yeah. So on a normal weekday, I think we all see that. I live in LA, so I never thought about parking prices as much as I do here. But, a normal weekday, it might cost $10 to park in a parking lot. On the weekend, higher demand, more people, $20 to park. And then let's say Ariana Grande and The Weekend are in town. Guess what? Parking's going to cost $50 that day because
More
of
than the concert price.
yeah, yeah, almost. So that's a good way to consider IV. I know with, plays like GameStop and AMC, we saw a lot of high IV on those because there was a lot of speculation for a bigger move, right?
Right. Yeah. So I think that's a really good explanation for IV. And which brings me to Vega. Now, Vega is the measurement of an options price sensitivity to changes in this volatility of the underlying stock. So very easy to explain this. It just represents the amount that option contracts price changes in reaction to a 1% change in the IV of the asset, underlying asset, which in this case is a stock. So let's say that we had earnings for Apple and the IV was 100, For example, Snapchat had IV of 500%. And that means that the priced in a market is already pricing in a bigger move, like 5 to 10% up or down. So that doesn't really help. Like if you buy a contract and IV crashes, it's bad for the premium, and both of them are gonna get burned, calls or puts.
Yeah, absolutely. And that's where the IV crush comes in, right? Because a lot of people think like, oh, I bought calls here and the stock went up, like I should definitely make bank, and then they're a little disappointed the next day when they check their account and the IV crush sort of nicks to that move, right?
Right.
Okay, so we've got our Greeks covered, we've got IV covered. One other really important thing I think we need to discuss in this is volume, open interest, and spreads. Essentially, when people are talking about the liquidity of a contract, what the heck does that mean? You want to dive into that for me, Drippy?
Right. So the volume basically is the number of contracts traded on that day. Like you buy a put, I bought a put, let's say other people, everyone bought the put, and you sold the put on the same day, right?
Mm-hmm.
All of them combined together is the net volume. So in this case, how many tickets or how many parking passes were purchased in the same day? Um, and open
Purchased and sold, right? Because it's
purchase and
buying and
sold.
selling.
Right, buy and selling. And for example, you move the car the same day outside. You came in, after a couple hours you left, and those were the the volume, net volume. But open interest is very similar, but the only thing is that how many cars were still in the parking lot.
So how
How
many
many cars
positions are still
still
open?
open, right? Like that's the open interest. How many parties are interested in that contract, and it could be sold contracts or it could be bought contracts, so you need to be aware of that.
So you want to have open interest and volume to show that a stock is liquid. When an options contract or play is liquid, that means you can get in and out much easier and there's a tighter spread. The spread is the between the bid and the ask. So there's not like a 20-cent spread or a, 10% spread. The bid and the ask are much closer. There's more demand, there's more volume, there's more liquidity. Sometimes there are great charts out there, great plays, and I'm so tempted to play them. But then I look at the contracts and I see it's really not a very liquid name. Um, and normally I'm a little bit more hesitant to play those, unlike something like, let's say, NVIDIA or SPY or um, AMD. Like those are some of the really liquid names.
Right, the spread basically, market makers use spread as a tool to cover their risk, because the stocks which are not liquid, in case something happens to them, in case they rip or they fall drastically or dramatically, and people who are owning these contracts, especially market makers, right, um, they need to mitigate the risk, and that's why these premiums for some of these stocks have weird, because they are not liquid. The spread is very, very wide, and there are many other reasons which um, kind of hard to describe in this small segment. But yes, you need to be aware of the spread, and sometimes it's just you might be bullish on a stock which is a small cap, but it doesn't mean you should buy an option for it because the spread is terrible, 50%. Like for example, I see people buying uh, uh, at ask, if a spread is zero point 0.1, bid is 0.05 and ask is 0.1, basically $5 and $10. They're paying $10, but you're not realizing that, these out of money calls actually are 50% difference in the ask and bid spread. So that's huge.
It's huge.
Yeah, you're basically buying and losing money, because nobody's gonna
Yeah.
buy it at that level unless someone else is interested in that, right? So sometimes it does make sense to buy a little bit closer to the money than completely out of money, for especially for stocks which are not that liquid. The chains are not liquid.
Yeah, and there's a quote from Linda Rashke. I don't remember what it is exactly, but she mentions that it's not hard to get into a position. It's often much harder to get out. So you always have to be very mindful about the position you're taking, and your entry looks a certain way, but what's it going to look like when you're ready to get out? Are you going to be able to get what you even paid for it? If the play isn't liquid, then it's probably not going to work in your favor most of the time. I actually have a concert ticket analogy for this. So,
Oh my.
oh my. So let's say that The Weeknd and Ariana Grande are coming to town, right? I
Right.
want to buy tickets and I want to flip them because I know that it's a hot concert. I know it's probably going to sell out. I know there's a lot of demand, right?
Mm-hmm.
So if I buy tickets to that, I can easily resell them for face value for sure, but
Mm-hmm.
maybe even significantly higher because the
Mm-hmm.
demand is there, right? People are
Mm-hmm.
going above ask for these concert tickets.
Right.
On the other hand, let's say there's a local, LA band that's coming to town. They're
Mm.
known okay, but they're nowhere near Ariana Grande and The Weeknd level of
The
popularity,
the
right?
pony the pony too hard band.
The Pony Too Hard band, yes. Well, I hope the demand is high for that because I want that concert to sell out.
Right.
But so say there's a local band and I want to flip tickets, so I go and I buy a bunch of tickets. And when I go to sell them, I realize there's nobody really in the market for these tickets. So maybe I
Mm-hmm.
bought them at 20 bucks a pop. Frankly, I might be lucky if I can even sell them for 20. There's a good chance I might have to sell them much lower because the demand is simply not there. It's not a liquid show. It's not The Weeknd and Ariana Grande. So that's sort of a concert ticket analogy that I like to think of.
Yeah, absolutely. That's a really good way to put it.
Yeah, and so these are, just the next few sets of terms that we thought were important for your options trading journey. In terms of the Greeks and everything we discussed, do not get overwhelmed thinking you have to understand the ins and outs of all of this right away. Like I said, the two most important for me when I was starting out were delta and theta. Grasp a good concept of those and then just brush up and continue to get familiar with the rest. What do you think, Drippy?
Yeah, and if you want to learn more about these, and if you're interested in, like kind of see how to use them in your day-to-day trading, then we do have a workshop planned sometime in the future. We don't know when, but if you're interested, you can sign up in the form, which we'll link in the description of this, and we'll share it on the Twitter account of Straight Into Options, and let us know.
Yeah. And then we did put out a poll last week to see what you guys wanted to cover as our next topic. And the winner was when to average down versus cut.
Oh my, this one is a
Oh,
difficult one.
I
This will be
am
interesting.
I am very passionate about my response to this topic. So stay tuned. Drippy and I will be back next week, and we're going to dive into this hot topic with some potentially controversial takes. So we hope you join us. And do give us a follow at Straight Into Options on Twitter. That's at STR8 into options. And we'll continue to do more polls and let you guys have a say in what topics we cover because we love hearing from you.
Yeah, and we love all the response so far. It has been great. People have reached out to me on my Discord and saying that it was awesome. They love hearing us. And, if you like the content, please do like the posts and subscribe to the YouTube channel, especially for this in the future. We'll have guests and a lot of cool things planned for you guys.
Yeah, we're excited. We're just getting started.
Yep.
All right. We will see you guys next week.
See you later.